Welcome to another VC Wisdom Pod. We have Yash Patel with us. He's general partner at Telstra Ventures in the SF Bay Area. The guy spent some time in London, spent some time in LA. Now he's in the SF Bay Area. Very cool guy with a bunch of experience, cool investments as well, which we're going to talk about, amongst others, Snap, BigCommerce, opengov. That's one of my favorite that we're going to discuss about today, and a bunch of other investments, mostly Series A, some Series C as well. So this podcast is brought to you by podpair.com. That's my company if you want to start or scale podcasts. It's also brought by Polia from Neurohacker if you want to optimize your brain. It's the best nootropic I had my hands on till the last 5 years. I've tested a bunch of supplement for the brain, for memory, energy, and all of that, and that one is pretty kick-ass. Yash, eager to talk about everything you're up to nowadays. Give us a quick intro and tell us a bit more about Telstra.
Yeah, no, thanks for having me, Charles. My name is Yash Patel. As Charles mentioned, I'm a general partner at Telstra Ventures, investing sort of in post-product market fit inflecting companies. And as you alluded to, Charles, that can be Series A, B, or C kind of tech companies. But I try not to get lost in the semantics of what's defined as A, B, and C. But really, we're just trying to find great entrepreneurs, great product market fit, strong conviction, and sometimes a bit of a contrarian thesis in some of these sectors we're investing in. We have about $1 billion in assets under management, and we're investing out of our third fund right now. And a lot of the sectors are very interesting. Climate tech is a newer one that we've kind of executed on, but many around kind of traditional vertical SaaS or enterprise software companies. Cybersecurity is always a hot topic. AI kind of pervades a lot of different sectors. Gaming and esports has been an area I've spent a lot of time with in the past, and it's kind of come back in vogue with many other larger funds raising big gaming, esports, and gaming infrastructure funds. And then, I'd sort of say we're very opportunistic and take a very data-centric approach around how we source, qualify, and then also add value to many of our companies. And so what that practically means is we have a data science effort to help us kind of score these companies and help us due diligence, and then help us benchmark and add value to the CEOs and management teams of these companies post investment. So that's pretty kind of exciting and unique. But yeah, very excited to be on here.
Yeah, about $1 billion in assets under management. You led 96 investments ranging
Yep.
from 5 to 15 millions, 38 liquidity events. That is a lot. How do you achieve that, I guess?
Yeah, no, it's actually now to 44 liquidity events. So we just had one most recently that we'll probably talk about in a second called opengov. But the reality is, we're investing with sort of a 5 to 7, maybe 8 year time frame in terms of our hold. So when we invest in these entrepreneurs, we have sort of certain milestones in mind that, the entrepreneurs are aligned with around scaling, around hiring the right management team as they scale, around kind of product milestones. And once these kind of milestones are hit, we are in a good position as value-added investors to kind of introduce them to the next stage of growth investors. So these are a lot of the growth funds that can be a good partner to help scale them to a trade sale or an IPO in a really good scenario. So for us, liquidity is not the end goal. It's sort of a byproduct of a lot of the hard work our entrepreneurs and ourselves kind of put in to helping build these companies. So we like to roll up our sleeves and get really involved with everything from recruiting to strategy, where it makes sense, and where the entrepreneurs would like our help. And then most importantly, introductions and moving the needle through kind of revenue, kind of generating intro. So on the commercial side, biz dev side, that's where we can kind of add a lot of value as well. So it's really a byproduct. And if everything works out well and the stars align, we do see a nice outcome in the form of companies going public like Snapchat or, a few other gaming companies in my portfolio, or a nice little trade sale or exit to a strategic acquirer where that company can then go on to flourish and grow even further.
And how long does it take you in average to leads to reach liquidity events? I can see from your LinkedIn here, I would guess like probably around 6 years.
Yeah, that's a good guess. And I don't have the exact data around our specific fund, but I'd say like 5 to 8 years is kind of on average, kind of typical. A lot of it sometimes results in, the companies are fundamentally sound, but the macro environment can be a bit unstable, as we've seen the past few years around the IPO markets being a bit cold or credit being a bit short and sort of interest rates rising. And so some of these things are out of our hands, but what we do guide our companies to do is in the last few years is really be disciplined around everything from unit economics to kind of burn, but at the same time being thoughtful about how to grow or do more with less. And so that's something that we preach, and many of our entrepreneurs have over the last few years been very focused on. And now, as we kind of think about the future and beyond, and the macroeconomic environment is uncertain, we think they're in a lot better place to move forward. So I'd say 5 to 8 years is kind of typical. A lot of times we get preempted with M&A term sheets from very strategic acquirers who tend to be partners of our companies, and really get excited with that strong synergy. And so that kind of might kick off a potential dialogue with investment bankers on whether we should go public, whether we should do a more thoughtful kind of process with reaching out to other strategic acquirers and ultimately generating a good kind of premium or money multiple return for all the stakeholders on the cap table. So that's kind of how we kind of think about things, but that's kind of like a byproduct of all the hard work that goes in early on.
Right. And tell me about the founding of the firm, Telstra. Basically, you were working in finance, probably a comfortable job, at least 250K a year. Uh, why did you leave that? And tell us about like how the company, the VC firm you're running, was founded.
Yeah, so look, to give you some context, Telstra is basically like the Verizon or AT&T of the Australia kind of Asia Pac region, the largest telecommunications company in that region. And when I joined, gosh, over 10 years ago, almost 10 and a half years ago, I feel like I should have a Rolex watch now for my 10-year anniversary. But all jokes aside, we were basically being run by very thoughtful partner, my colleague, Mark Sherman, out of our San Francisco offices. It was just him in North America. And so he brought me on along to basically grow our North America operations, and really kind of expand our reach into a lot of sectors, across the tech ecosystem, which is so broad and just can increase our velocity of deal flow. So in the early days, we were actually part of Telstra. We were the corporate venture capital arm of Telstra, not too dissimilar to other kind of corporate venture arms that you might have seen around the world. And really, we ended up spinning out of Telstra in 2018 with Telstra as a major supporter and anchor limited partner, along with a host of other institutional funds. And that first fund was very much made possible by some early success we had in companies like DocuSign in the e-signature space, or Box in the cloud storage space, where we'd made investments and gotten real liquidity for Telstra, which was happy to kind of help shift the burden of capital to kind of other institutions, but also benefit from that strong relationship with us. So fast forward to today, we're totally independent from Telstra, but we're backed by them as a major anchor LP. In our most recent fund, a third fund, a $350 million fund that we're investing out of. But then we've got a host of other kind of family offices and institutions that back us as well. So in many ways, you can kind of think of our evolution as similar to maybe Google Ventures and their relationship with Google as a parent there. They're independent, but they're backed by Google. Or SAP, when they spun out Sapphire Ventures, if you're familiar with them, they're independent, but they're backed by Sapphire. So I think those analogs are pretty appropriate. And we know all those folks at those funds very well, and they've all kind of gone on to do great things. So that's kind of our evolution over the last 10 years. And so it's been about 6 years since we've been independent, and we're really excited about the future.
Right. And why only 20% in international investment? Why the US focus?
Yeah, it's a great question. We actually used to do a bit more internationally, but I think the nature of the density of kind of talent and capital tends to concentrate in North America, and specifically San Francisco, LA, New York, Toronto, and Canada, and other kind of areas, throw in, Austin, Texas, and we've had a few companies like BigCommerce headquartered out of there, along with Miami and Florida as well. And so for us, we just want to be in front of, thought leaders and people that are kind of pioneering the future. And they tend to gather in density across these epicenters. And so the fact that our portfolio is mainly US isn't sort of by necessarily design. It's actually just a byproduct of really where the best entrepreneurs have been operating, along with where the capital sources are. I'd say as a proxy of that, all those epicenters tend to have strong kind of pools of talent, technical talent, especially from local universities that feed into this ecosystem as well. So Stanford and UC Berkeley here in the Bay Area. But then you've also seen sort of big exits that have then had money recycled back into the ecosystem. So in the case of LA, it really got put on the map when Snapchat went public, and then all those kind of Snapchat mafia folks ended up creating their own companies, investing in seed funds, and propelling that ecosystem. So I think those ingredients are important. And that's kind of why we end up, with our portfolio of our 97 companies, about 80% are in the US. Having said that, we see a lot of great talent in India in particular, with a lot of technical talent that partner with many of our US companies. And so many of our companies are cross-border by nature, with R&D teams in Israel and India, but they're technically headquartered in the US, where a lot of their customers, management teams, and some of their key talent are based.
So let's check some of your investments so far. Talking about Snap, should have Evan accepted Zuck's offer back then, or was it a good move to keep on going?
Well, I'm very happy he didn't, because we wouldn't have had the chance to invest. But the reality is, back in the day, Snapchat was sort of a very simple app that, if I were to be crude, was a sexing app used by teens, right? And that's kind of how it grew. But really, they ended up evolving to this broader kind of digital media platform for, millennials at the time, and now Gen Z, that ended up offering a pretty comprehensive kind of interactive entertainment experience that attracted a ton of advertisers. And then they built out their programmatic ad ecosystem over time that ended up making this scale in a much different way than they originally envisioned. So, Snapchat was a really exciting investment, for us. We ended up, investing right before they launched their Discover portal, if you remember that, back in the day. And that Discover portal was driving a lot more engagement. It, at the time, looked like a next gen kind of media, or CNN, or I guess a next gen Comcast, in that it was sort of producing all these different channels, everything from food and travel. And so it moved beyond just kind of texting, messaging, and kind of that type of engagement. And then there was a lot of things on their roadmap that, to be open, they were very coy about, that were really exciting. So Snapchat for us was a very exciting investment. Not only helped us, get a bit of credibility in this space, but we felt like they were moving in a direction that could, expand growth. And then they eventually figured out India and sort of Android penetration, which ended up skyrocketing their stock moving forward. And then they're in AR, and they're looking at AI now. So really proud of the team, at Snapchat.
Then BigCommerce, which most of us know. I mean, there's WooCommerce, there's BigCommerce, there's obviously Shopify. That was a home run investment for anyone that had the luck to invest in early Shopify days. Now, BigCommerce must have been a pretty big home run as well. Tell us about your thesis on that one and about that 2022 exit.
Yeah, thank you. Yeah, so like BigCommerce was really interesting at the time. You had a whole bunch of players in this e-commerce infrastructure space. You had a lot of folks like Magento, more at the high end, sort of open source tools to kind of build these websites with a lot of developer resources. That's not practical for mom and pop merchants. You had a lot of folks like Shopify, we talked about, was the big player at the time that was really going after the smaller end of the market. And then BigCommerce was sort of competing in the same space as Shopify at the time, right? They were actually not mid-market, which is what we know them as now today. And we invested when they and Shopify were sort of competing a bit more directly with each other. And then over time, it became very clear that Shopify had won the lower end of the market and were doing a great job of sort of this closed ecosystem of, hey, this is a one-stop shop. We can provide everything from marketing tools to payment options to website hosting to all these things that these mom and pop merchants needed. BigCommerce realized very quickly there was a need in the market around the mid-market that wanted a more open kind of architecture. So they didn't necessarily want to be fed a less, than ideal point solution that Shopify was kind of suited for, more at the low end of the market. And so they created this kind of open kind of app store, and you can kind of pick and choose what vendors you want to work with. And that's the big pivot that BigCommerce made that ended up driving a lot of their growth in the later years up until 2021 when they went public in the height of sort of this kind of boom market that we were at, and it was a really nice outcome. There was definitely a lot of strategic M&A interest in the company at the time, so we had to be thoughtful about, do we go public? Do we kind of just settle with a nice little M&A outcome? And eventually we sort of realized the public equity markets were valuing the company or ascribing a revenue multiple that was more interesting than the strategic folks. So that made sense for us to go public at that time. So Shopify obviously has gone on to be a huge company, and BigCommerce is definitely doing good work in the mid-market segment. But we thought that there was an interesting TAM across the whole e-commerce space where you needed to democratize access to website building across a large swath of customers, not just SMBs, but mid-market, as well as the enterprise side.
So if we round numbers up here, let's say that you dropped a $10 million check for them, that got you probably 5% of the company, and their valuation when they got public was probably 100 million. So is that a 50 mil exit? Am I in the right ballpark?
Yeah, I can't really talk about multiples or exits just because it's sort of not our policy, but it was probably one of the bigger winners in our portfolio. Like I would say that. So of our 97 companies, we've had 44 liquidity events. I think it's top 5. Like just to put it in perspective. So it's been a really nice outcome, and the team has gone on to do some great things. Obviously the equity markets have kind of been very choppy since 2021, but we were fortunate to kind of liquidate and get good liquidity for our LP investors, in a thoughtful way. So that's been really exciting.
Then I see two other investments after that, one Series B and Series C. You say that you didn't discriminate too much as per if it was Series A, B, or C.
Yeah.
But I mean, there's a lot of factors that go into these decision. What makes a Series C or a Series B attractive to you vs a Series A?
Yeah, so I should kind of step back for a second and give you some context on our fund. In kind of 2018, 2019, 2020, up to 2021, we were doing more Series B and C. Our key criteria was, could we underwrite an investment at that stage that gets us a 5x plus return? And at the time, it made sense because the public company multiples were trading at a really healthy valuation, 10x plus, maybe even 15x, I think at the time. And so if we got into a company at 5x or 7x revenues, next 12 months revenues, it totally made sense. And we could see an outcome where, the company could go public or even get acquired by a strategic acquirer that would pay something that was similar to those public market multiples. Fast forward to basically 2022 to now, the markets have sort of recorrected, and they've gone back to a mean of where you kind of see anywhere from 5 to 7x next 12 months revenue multiples for kind of best-in-class SaaS companies or tech companies. And so for us, we sort of quickly realized two things. One, Series A was more interesting to buy a bigger equity ownership stake in these companies and get less diluted over time and move the needle for our fund in a bigger way than having a larger percentage of Series B and C companies where we owned a smaller, 1 to 5% stake, right? So that was one. Two, we could kind of add more value and focus our efforts on these Series A and B companies where we have a board seat. Typically, if you have 10 to 20% equity, you'll take a board seat, and we could kind of help out these companies in a more thoughtful way and influence, with the entrepreneurs' kind of blessings, ways that they can kind of, grow their businesses. And so for us, we felt like we would have a bigger impact at the earlier stages versus I think B and C, you typically don't have as much influence, and the companies are generally doing fine. But at the same time, they can kind of not get the same kind of risk reward profile in this current equity environment. So for us, Series A is like 1 to 5 million in ARR, growing 3x year on year. That's perfect for us. And we'll come in, we'll invest anywhere from 5 to 10 mil and lead or co-lead around, maybe even more, and then follow on, especially with some of our winners with super pro rata kind of rights that we have, over time.
Now, just to finish this off, because we're already short on time, I want to talk about OpenGov, which is a fascinating company. Tell us a bit more about that one and your thesis behind the investment.
Yeah, so I personally was very frustrated, with the lack of transparency with local, state, and federal governments back in 2017. And, I'd sort of heard about this company called OpenGov, which was offering this transparency tool for citizens in at the local or state level to basically view how budgets at the government were being allocated to police departments, fire departments, all sorts of social services, et cetera. And I thought it was really important to kind of have that level of transparency. And so that was their original software tool that they were selling at the time in 2017 when we participated, 2018 when we participated in that investment. Over time, it became very clear that these governments were very antiquated in how they operated. They were very much on-prem software solutions. In many cases, they were just kind of pen and paper that were sort of the status quo. And so everything needed to be digitized, moved to the cloud, but it was very hard with sales cycles to kind of sell software into the government. And so OpenGov, the CEO, Zach, he's a force of nature. He basically cracked the code and figured out how to kind of deal with these long sales cycles, get into procurement and security, and then ultimately become a very sticky tool that these governments embraced and loved to basically provide better budgeting, better permitting services, better transparency tools for their end constituents and stakeholders, not just citizens, but also others in the government, others, government employees that need access to this data. So that's been where they've evolved. And now they've gone from this point solution to this full-blown ERP tool that basically is for governments. And so they had a lot of inbound and strategic interest. And one of those companies was called Cox Enterprises, which was actually a strategic investor in some of the later rounds of OpenGov. And so they ended up getting very excited about the strategic partnership with OpenGov to kind of basically resell OpenGov and create their own kind of third pillar of their business, around kind of gov tech tools, and ended up acquiring the company not too long ago for $1.8 billion, which was a really nice kind of outcome for all the investors. And so I don't think that's the norm, but I think that's just a testament to Zach and the team at OpenGov and their tenacity, because it wasn't an absolute up and to the right type of story. There was definitely a lot of issues, sales cycles I talked about, you definitely have to think about cash burn, and then eventually get back into growth mode. And they made some strategic M&A deals. They made some strategic hires that helped propel them to a really nice outcome. So that's one I'm really proud of, just because they're disrupting a very stodgy old industry around government, and we're able to win over a lot of hearts and minds there.
Well, Yash, thanks so much for the value today. Where can people find out more about you?
Yeah, you can find out about us on our website, telstarventures.com, www.telstarventures.com, or our LinkedIn site is really good. You can look me up, Yash Patel, and Telstra Ventures. It usually shows up there, and feel free to reach out, especially if you've got interesting companies at that series in A and B stages, kind of 1 to 10 mil ARR. Would love to chat.